Cash flows are the lifeblood of a business. More businesses have failed because they did not have sufficient cash flow. They may have had great ideas, but the cash flow just wasn't there. They didn't generate enough cash flow to keep that business going. Net cash flow is very simply net income plus depreciation and amortization. It is a rough idea of how the firm is doing. It is extremely important for a firm. The accounting earnings, the net income, is not necessarily going to be the same as cash flow. Does a firm have a lot of non-cash charges like depreciation and amortization? Only cash flows are going to tell you if a particular decision is indeed a wealth-increasing decision. We are going to need to convert profits into cash flows in order to make those very important decisions. The firm has a statement of cash flows that uses the information from the income statement and balance sheet to determine how much cash a firm has generated, how much cash has been allocated and where it has been allocated to during a given period. Cash is important. It's needed to pay bills, maintain operations, and it really is the source of any return to investors. Cash flow is one of the most important pieces of information that a financial manager can derive from financial statements. The statement of cash flows does not provide us with the same information that we're looking at the other financial statements. It takes that information and tells us how the cash is generated and how it is spent. How is the company using its assets? What cash is being generated from those assets? Looking at market-to-book ratios, tech companies, highest market-to-book. Large firms, pretty darn high market-to-book. Service companies tend to have lower market-to-book, and a large part of that is that for these kinds of companies, their assets are their human capital, their ideas. That's why we tend to see financial services and other kinds of service companies having a book value that's pretty close to market value. With the tech companies, large firms, it is how they are going to use their assets that matters more than the actual value of those assets. Here's General Electric. Looking at General Electric's earnings over time, we see a nice, smooth, even trend. This is something that is less likely since the advent of Sarbanes-Oxley. This bill says you must declare income when you get those revenues, you must declare expenses when you make those expenses, and has made it harder for companies to do what General Electric has done. Again, it's not likely that they're able to have such nice, easy, smooth earnings without some accounting manipulation, which was more legal before Sarbanes-Oxley than after Sarbanes-Oxley. Looking at enterprise value or firm value or the value of the firm's debt plus equity. Let's look at that. Market value of equity or market cap. Number of shares times price per share plus debt. Now, most of the time, the book value of debt is pretty close to the market value of debt. There are some exceptions, but usually we can just look at the debt that's on the books and add that in to get enterprise value. Then we subtract cash. That's an interesting point. Why would we subtract cash? Cash is valuable, and it's certainly easy to value. If a company has cash, we know how much that's worth. The reason that cash is subtracted is that some companies have excess cash. They have cash that is not invested in productive assets. And it is the productive assets, the future cash flows from those assets, that determine the value of a firm. So we subtract out excess cash, cash the company is currently not using for investment, and its enterprise value, its ongoing value, the value of the firm's future cash flows discounted to today's price. That enterprise value is the market value of its equity, preferably the market value of its debt if that's available, if not the book value of its debt, minus any excess cash that is not being used productively.